Hey everyone. Welcome back to Finbot's Insights, your go-to channel for all things finance and investing. Today we're diving into a seismic shift happening in the world of investing, a battle that's been brewing for ages but is hitting a fever pitch in 2025. That's right. We're talking about the clash between index funds and actively managed ETFs. Buckle up, because this is going to be one wild ride through the stock market landscape, with some jaw-dropping stats and trends that might just change how you invest. Let's get into it. For decades, index funds have been the undisputed kings of the market. They're cheap, they're simple, and they've delivered solid returns by just tracking the broader market. Think of them as the steady, reliable friend who always shows up on time. But guess what? There's a new kid on the block, and they're shaking things up big time. Actively managed equity ETFs are staging a comeback, and they're stealing the spotlight in 2025. According to the latest data, these active ETFs are pulling in more assets than their passive index fund counterparts. We're talking net inflows of $3 billion into active equity ETFs in just one recent week, offsetting a staggering $4 billion in withdrawals from index funds. That's a net outflow of $1 billion from equity ETFs overall, but the active side is clearly winning hearts and dollars. So, why the sudden shift? Well, there are a few big forces at play here. First, we've got a new wave of younger retail investors jumping into the market. These are the Robinhood traders, the YOLO crowd, who aren't afraid to take big risks. They're leaning hard into leveraged and inverse ETFs. Think single stock bets on companies like Tesla or Nvidia. We're talking $10 billion in inflows this year alone. And here's the kicker. Less than 5% of these ETFs are held by institutional investors. This is pure retail frenzy, folks. It's exciting, but it's also a bit like playing with fire. High risk, high reward, and sometimes high regret. Then there's the market volatility we've seen in 2025. Stocks have been on a roller coaster with whipsaw action that's had investors on edge. Just look at April. The market tanked as much as 13% at one point after global tariffs were announced by President Trump, only to rebound fully by the end of the month with the S&P 500 posting its longest winning streak in 2 decades. That kind of chaos makes people rethink the set it and forget it vibe of index funds. Active ETFs, with managers making real-time decisions, suddenly look like a safer bet, or at least a more responsive one. And let's not forget the explosion of new active ETFs hitting the market. This year alone, 288 new funds have launched, with projections of over 1,000 by year-end. There are now more than 2,000 active ETFs out there, rivaling the number of index ETFs. Sure, they only hold about 10% of total ETF market assets, but they've snagged a whopping 34% of this year's inflows, $132 billion out of $363 billion, to be exact. As John Mayer from JP Morgan Asset Management put it, actively managed ETFs are taking over the marketplace. And with funds like JP Morgan's popular income ETF, JEPI, offering income and downside protection, it's no wonder investors are taking notice. Now, let's zoom out for a second. Despite this active ETF boom, index funds still hold the lion's share of assets, $231 billion in inflows this year compared to active funds. Experts like Mike Atkins from ETF Action predict that passive funds will continue to dominate traditional investing strategies, holding 80-90% of assets overall. But the trend is clear. The active tilt is here to stay, especially in niche areas like income strategies, buffered ETFs that limit volatility, and those spicy single stock plays. So, what does this mean for you, the investor? First, don't panic when the market goes crazy. As Bob Pisani from CNBC's ETF Edge wisely said, "Don't do anything stupid when the market is crazy." History shows that staying invested through the ups and downs pays off in the long run. Think about this. If you sold on a 5% down day in April, you'd have missed a 10% up day shortly after. That's a huge hit to your long-term returns. Time in the market beats timing the market every single time. Second, if you're tempted by active ETFs, do your homework. Not all active funds are created equal. Some are just closet indexers, mimicking the market while charging higher fees. Look at metrics like R squared to see how truly active a fund is. Firms like JP Morgan and T. Rowe Price are doing deep bottom-up stock analysis, while others might just tweak an index with a fancy model. Know what you're buying into. Here's my personal take. While I love the simplicity of index funds and they'll likely remain the backbone of my portfolio, I can't ignore the innovation happening in the active space. Funds offering income and downside protection are particularly intriguing, especially in a volatile market or when bond yields are making fixed income less appealing. About 60% of bond ETF flows this year have gone into ultra short-term bonds because of that uncertainty. Active equity ETFs could be a smart way to balance income needs with market exposure, but they're not a one-size-fits-all solution. Looking ahead, I think we're going to see even more creativity in the ETF space. From synthetic income strategies to leveraged single stock funds, the spicy side of the market, as Akins calls it, is only going to grow. And with the SEC potentially greenlighting conversions of traditional mutual funds into ETFs, the floodgates could really open. So, what's your take? Are you sticking with the tried and true index funds, or are you dipping your toes into active ETFs? Maybe you're one of those bold YOLO traders betting big on single stocks. Drop your thoughts in the comments below. I'm dying to hear where you stand in this epic showdown. And if you found this deep dive helpful, smash that like button, hit subscribe, and ring the bell so you don't miss our next video. We've got plenty more insights coming your way on Finbots Insights. Until next time, keep investing smart.